All right, well, the markets started the week off on a relatively positive note, really gapped up, got pretty significantly higher. The problem is, instead of continuing up and just kind of running away like we saw in the opposite direction a few days ago, we actually filled in this morning's gap pretty quickly and actually closed near the lows of the day rather than near the highs of the day. So it wasn't as bearish as we've seen in the past week, but also it wasn't as bullish as what it appeared to be when we opened up this morning. So a little bit of a mixed picture. Not surprising for a Monday when you get a mixed picture. Mondays tend to be pretty quiet. We have some economic data, some earnings, especially some retail earnings coming out this week. So there are a few things on the docket. We're through options expiration. We're almost to the end of the month for February. So some important technical things that are going on I'm going to highlight in today's video. We're also going to take a look at what's driving this price action like we normally do. Some interesting moves as we've been mentioning previously in the dollar and bonds that have been so relevant to risk appetite in general, obviously including equities. So we're going to break those moves down to see what they tell us about what we should expect this week and going on to next week. And then our trade idea in the financial sector on the stock that may be telling us which way the market is headed. And we'll talk about how to trade that. So let's go ahead and get started. Today is Monday, February the 27th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon or the red subscribe button. Hit the thumbs up icon to like our video, comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching here on our blog, check out some of these other things over here on the right, including our Market Outlook live video I do at 3:30 Eastern time on Monday, Wednesday, and Friday. Come down here to the bottom, click that heart, it opens up this tab, hit that like button. Same thing here, hit the thumbs up icon to like that button as well. Again, the more you do that, it helps us tremendously. It helps get our content out to everybody who follows us on those platforms, as well as it's getting people to our website. So these are free videos. We appreciate those who do like, because that's what we get out of it is when you do like and comment and share. So thank you to those who do that, and then those who don't, you can do right now while you're watching with a simple 1 or 2 clicks here. All right, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator like we always do. We have dark pink shading and a red line now. We're not below the 2.5% mark, so we're still kind of shallow, but we are deep enough for long enough now, 5 days, that we brought the moving average lower. That's what the red line is. The dark pink shading comes from the fact that we dropped below the 50th percentile on Friday, and then now today dropping into bearish territory. You can see the near-term line trying to get above the intermediate line, and so we'll see again when it's in bearish territory, it can get above it. You can see over here. The question is when it gets back down, like how far and how long. If it gets up and stays up, then that's what brings the intermediate line higher, right? If it doesn't get back down below it, and it only does briefly when it does, and not until the intermediate line's higher. So it's trying to get up there. It's not quite there. Market sentiment, the intermediate line is still below market sentiment, and it's falling. So it's still barely below 60, but it's falling there. So you can kind of see how it's shaken out for the S&P 500. If you take a look at the Dow Jones Industrial Average, it's been a little bit more bearish lately. Its intermediate line is actually in the lower reversal zone. And short-term sentiment is still bearish, and the market sentiment line is really falling. And you're still at 2.5%, but we have been dark pink shading in a red line now for 4 days on the Dow. So it's been a lot more bearish. The Nasdaq's been a lot less bearish. In fact, it barely got a new bull tag today. The bull tag, meaning that we crossed below, in this case from the open, below the 30-day moving average with light pink shading, or a yellow line and light pink shading. So another bull tag, and again, whether or not we close above this, and get up above this level will signify whether this bull tag is a bull tag that launches a new bullish move, or a bull tag that turns, starts a bearish move. It's kind of the tipping point. You would expect the bearish move because the intermediate line is crossing below market sentiment. Market sentiment is still rising, but we have now crossed below it, and you can see bearish short-term sentiment still. Let's take a look at the Russell 2000. And you can see again, it's been less bearish here lately. It also has had multiple bull tags here recently. Got one on Friday. But now we have dark pink shading, and we have cross below market sentiment that is also still rising, but short-term sentiment is still bearish. So, you know, we're down. We're not like breaking down hard, but we're also not bouncing, and we're still in bearish mode. So we're still kind of in the beginning stages, kind of similar to, you know, when you're just starting something like this, when you're just starting to be bearish before you really break down hard and you get below, so you're kind of below the moving average at shallow levels, but then you break down harder. For the S&P 500, that level is 2.5%, right? When you finally break below that 2.5% mark, that's when you really start to break down. Until then, if you're just kind of hanging around the 2.5% mark, you're just not that bearish. So that's kind of happened over here, where you just barely got below 2.5%, never really got going to the downside there. A lot of these other times, so we're less than 2% below the 30-day moving average, and also considering now that the 30-day moving average is falling here. So that's how the market forecast looks. Let's take a look at the weekly chart. And you can see we are getting a crossover, a death cross. After a brief golden cross, we're getting a death cross here on the 10 and 40 week moving averages, the equivalent or proxies for the 50 and 200 day. These are also exponential moving averages rather than simple. But you can see the 10 week exponential has crossed below, or is in the process of crossing below the 40 week this week. You can see that we are getting, we don't have a lower low point, but we do have a lower close after this reversal and after the red arrow. You can see the Heikin-Ashi differential is still below its moving average on a weekly basis, so we're still in bearish mode there. Let's take a look at the 3 green arrow charts. I showed you we've had 3 red arrows for 5 days on the S&P 500, just the last 2 days on the NASDAQ, for even longer, for 6 or 7 days on the Dow Jones, and then the 5 days here, I believe it's 5 days on the Russell 2000. So, I mean, we are clearly in the beginning stages of a bearish intermediate run. Like, if we're going to bounce off of those bull tags, and these pink shadings should only last 2, maybe 3 days, more likely 1 or 2 with a possible third, but we are well into 5, and you know, the NASDAQ's the only one that's still kind of in that hopeful stage. Let's take a look at the 2-line version of the chart. We are still below the 17-day moving average. MACD is still below its moving average. Histogram appears to be bottoming out, so that's something to keep an eye on. The MACD or stochastics is well into oversold levels. We are flirting with that 50-day moving average. We closed below it on Friday. We got above it today, got up to the 8 before coming down and finishing more towards the lows of the day. We are now down below these lines, the 30-day long enough that the 8 and the 17-day have crossed below 30. It's pretty significantly bearish. That typically signals we got more downside potential than upside. Remember, we do have the 50 and 200-day moving averages. We've been trading in these gaps, so we need to kind of break. If we break the 50 and the 200-day moving averages, we'd obviously be breaking below the point of control, as well as these important Fibonacci levels that I've highlighted before. The 62 of this intermediate trend that we never did reverse. We had a couple fake outs, and then the 38% of the market of the correction that we've had since that early 2022 high point. So obviously we're in bearish mode on that perspective as well. Looking at some of these other oscillating indicators, if you look at the DMI, we still haven't got that big time move up. We're in fact the negative indicator dropped back below 25. And the positive actually jumped back above it. So technically, I mean, again, that's another hopeful sign that we might be actually bouncing here. I remember getting above these highs where these bull tags have occurred on the market forecast indicator would be the signal that would be, again, nothing's 100%, but would be the signal that we are reversing instead of going down to the downside. So that's something to watch for in the next couple of days. From an Ichimoku cloud perspective, we still have a positive rate of change for the next couple of days, unless we get up into this area. If we're going to go flat or down, you know, we'll have a negative rate of change in the next couple of days. We obviously don't have a bullish trend anymore. We're below both the blue and the green line, though we are still above the clouds. So we're still in that gap. Previously getting in that gap has led to bearish moves, right? As you can see there, and you can see over here. So let's see, you know, if this turns into a bounce instead. Again, unlikely it will turn into a bounce. We are in bearish territory on both these indicators, below the 50, below 0. We did get below minus 200 on the CCI, so that is strongly in bearish territory with that confirmation there. The RSI has not got its confirmation, dropping below 40 yet, so we're still technically in bullish levels and bullish ranges there. Looking at the Bollinger Bands and the Keltner channels, you can see we are still flirting with that lowest quartile, that expand, but we didn't get below the lower band. The bands still have not moved outside. They were really close. They've been kind of flirting back and forth today. Finished the day just barely inside the Keltner channel, so you have the red dots. But you can see the increasing negative momentum. And tomorrow we are for sure going to get the green dot. We're going to be breaking out. So the question now is, how much further do we get down towards 0 and potentially below 0, which means we're getting below that lower band there. So that, again, something to watch for in the next couple of days. I believe we are headed in that direction. The whole moving average, we did get a reversal today. We got a higher close. So we got a higher close there and we finished down. We got a higher close now. So now the question is, will we reverse and finish above this body or come back down with a lower close below this body tomorrow? And last time we got a higher close. We got the lower close below that body. And that's kind of what you would expect that we'd get again. Obviously, the parabolic stars are still above us. The hull is still red. We still are falling, though you are starting to, your Heikin-Yashi differential on the bullish candle is starting to move up a little bit. So we might be in a little bit of a bullish move. We are easily still in, oversold levels from a 4-week standpoint from the stochastics. We're still on the pace. Remember, the black line is the pace of the 2008 move to and through the 200-week moving average. You have it going down to 3,500 by mid-April. 3,500. If we were to get to that level, if we were to follow this trend, 3,500 would be below the 200-week. And obviously, considering the lack of volume in this area, you more than likely would be, and that would also be the lows of October. You more than likely would be going a little bit below that, potentially to the pre-COVID highs I mentioned before, 340, 3,400, or worst case scenario, all the way down to 3,200 on this move to and through the 200-week moving average. Let's take a look at today's intraday moves. You can see it was a higher high and a higher low. We closed right on, we filled in the gap, most of the gap, but pretty much filled in all the gap there, and closed on the high of yesterday. So it's relatively bullish. So we did close near the low of the day instead of the high, so not as bullish as we could be. We did not get a new 4-week low point today, so your rune indicator, we're coming off of 0, but remember, it has to get all the way below 70. It takes 6 days to do that. The range down here, the actual size of the 4-week range is low enough right now that we are set up for a breakout move, and you saw that with the Bollinger Bands and the Keltner channels. There's other in the Ichimoku cloud. Those trend strength indicators are also setting up for a breakout move. So we are setting ourselves up for a breakout move here in one way. And again, considering we've already had the move up to 0 to 100 on the red line, you expect that breakout move again would be to the downside. You see this gap here, which I believe was a common gap. I think this was our runaway gap that started this whole thing. We closed down with a significant gap and ran away from the open. I believe that was our runaway gap that starts the intermediate decline. I don't believe that this was a runaway gap or a breakaway gap or anything significant that wouldn't get filled in. I thought it was a common gap. It did get filled in today, and this morning's gap got filled in too. So that sets, now that we're through that, we don't have to worry about now having to go up to fill in any common gaps. And that's why I think, again, the pressure will be to the downside now that we got this move. Most of that, pretty much mostly overnight, right? Most of this gap fill was actually overnight and a little bit into this morning, and then it was done, right? You can see then we rallied or fell throughout the day to the downside there. Taking a look at today's volume and trading range, the range here was below average, 4.5 points. The volume was right on the average at 80 million. So when you put those numbers in context, 4.5 points is still, the ATR right now is at really low levels, 1.5%. So 4.5 points is really low. The volume also at 80 million is also relatively low, again below the average towards the lower end of the 52-week range. So there is some bearishness there that we're not. again, but we're bullish. We're bullish today, but we weren't strong enough with the volume and the range to really overcome this weak trend that we've been developing. The VIX is down. It's still in bullish territory because it's still above 95 percentile, but it's down. And you can see, again, the correlation of the VIX and the VVIX is down below 50%, which typically leads to bullish moves in both volatility and the volatility, the VVIX. When you look at the VIX correlation, obviously it's still very strongly negatively correlated, but we've had some positive correlations here that have been setting us up for the seasonally bullish move to the upside, and we're still in a seasonally bullish season for volatility going into March expiration, coming out of February. So we'll keep our eyes peeled for that going through the rest of this week. Again, you look at like the market forecast here on the weekly chart. To kind of give you an idea of what to expect this week, and you can see we got the light pink shading, we got the yellow line. We did not close below the moving average yet, but I expect that we will this week, and you'll get that bull tag, which is so rare to get in a correction, because typically you only get bull tags when you're starting a correction, which, again, that's the danger. If we get a bull tag right now that doesn't lead to a strong move higher, which I don't expect that we will. Tom Lee does, but I don't expect that we will. If we get a bull tag that instead leads to a strong move downward, those bull tags are the beginnings of the strong move to the downside. So that's the danger that we have right now. So you can see that my expectation still is, we're still not even below the moving average. And I think now that we'll have the lower high and lower low, that we're going to get that. In fact, if you look at the whole just barely turned. Let's see, the weekly whole, and just had its first down week last week. Right, so we just got our first reversal week after the lower close. We got the reversal week. We still haven't flipped the parabolics are up. We still haven't turned red. We're now 2 weeks in a row below the hole. We're just starting to turn down on the weekly hole. So I think we're just barely starting this move. And the money flow is obviously in bearish territory below 50. Had been below 40, bouncing up a little bit, but still in bearish territory there. Again, just starting with the dark pink shading and the red line, and then finally the McClellan oscillator, still very negative and still working its way down towards getting back below 500, which again has been the time for new intermediate declines. When you get back below these 500 levels there in August, and some of these other levels over here has been intermediate levels. But considering that we got up here, we failed, and again even worse failure up above 1,000, getting back below 500 would not be a good sign. It would be a failure. It would be a significant failure on the markets. All right, now let's take a look at what's driving this price action today. And you can see the biggest reason for the rally and risk appetite in general was the drop in the dollar, and that's what I was talking about earlier. Some moves in the dollar, long-term yields. You can see bonds were higher today as well. So drop in yields, drop in the dollar, lifted risk appetite. You can see really lifted its risk appetite, in the corporate bond market. In fact, when you look at here, so this is investment grade bonds relative to the 7 to 10 year treasuries, kind of a credit spread, so to speak. And this is yesterday, and you can see actually investment grade corporate bonds actually dropped and are below their 50-day moving average still. The 8 and 17 day have crossed below the 30. This is of this ratio chart, and they're still relatively bearish. You can see the long-term PPO is falling between the 50 and 200-day moving averages. There's a gap to fill there. But on the other hand, when you look at that high yield component relative to an even kind of more shorter-term basket, 3 to 7 years, then you can see actually HYG rallied. That was below the 50-day and starting to fill in that gap, but in the last 4 days, has really taken off back up above. In fact, the MACD has gone positive. The 8's crossed above the 17. They're still both below the 30, but they're rising pretty rapidly. And you can see that the long-term PPO also has turned back up above its moving average. You can see a positive histogram down there. So we'll see if this is something, right? If this is something that turns back into a, to a move to a higher high, like last time we came below the 50, we bounced off of that and moved up to a higher high. If we get back up into bullish territory here, or if we end up peaking without getting above 60 on the RSI and we roll back over from a lower high and kind of do a little head and shoulders pattern here. So I mean, you would expect the latter because that's what LQD is doing relative to its counterpart. But an interesting move in high yield, as you can see here, pretty much getting the same result as that long duration equity, the QQQs. So that's kind of an interesting development. Let's take a look at the chart here for HYG just by itself, and you can see, you know, it is still below its 17-day moving average, but its MACD down here just crossed above its moving average and got a green arrow on the MACD. So at the very least, you know, the downward momentum is halted in the last 4 days, and we are above the 8-day moving average. And we'll see, we got all these moving average above us here, and the 8 and 17 are both below the 30 and the 50. So we still got a lot of downward pressure, but we don't have the momentum anymore as we are in convergence mode, right? Convergence mode being above the moving average on the MACD, but still below the 17 days. So it limits the downside. It doesn't take away the downside, just limits the downside, the momentum, the pressure, and again, you would expect at some point in time you cross above the 17-day, like over here, and you start to move up to the upside. So we'll see if that ends up being the case. Of course, long-term bonds are also moving towards convergence mode. We've been in bearish territory. We're still below the 8-day, but you can see the MACD histogram is moving towards a green arrow. The UUP has made that strong move lower today, but again, not necessarily. You know, we filled in the gap between the 50 and the 200 day. I mean, that's not a strong reversal. It just basically, you know, we were so bullish here. In fact, when you look at the DMI for UUP, we have been so bullish getting up here that it's just a little bit of a pullback. In fact, when you cut this in half, when you look at the DMI on half the time frame, it's even more parabolic, right? We got about 40 and the negative got below 10. So we went a little parabolic here with Friday's move, gap up to the upside, and now it's just a little bit of a breather back to the 8 days. So that's the biggest reason why we had the bullish move yesterday, especially at the open, is that, you know, we were so strong in the dollar, but again, you're above the 90th percentile in the intermediate line. You're still in bullish territory despite the drop. You're still in bullish territory on the near-term line. Have been, right? We've been up above here, up above 50 for quite a while. We've been on this whole time. We've been on the near-term run without a pullback into bearish territory on the near-term line. And your momentum line's in oversold level, so we have an intermediate confirmation signal. So you would expect, based off of this signal, a little bit of a bounce back up. You know, now we'll see. It's a stronger signal when the near-term line's, you know, below 50, even better when it's below 40, but not too oversold. So we don't have that part of it, but it's still looking like it's got potential for a move up to the upside here. I did want to bring up the new highs and new lows index. It is below its average, so it did turn positive. It's back above 46. But remember the breadth here, we look at the breadth as well. It's kind of a, you know, both those things together, and still not turning back up. So we'll see if we can get back up above zero here on the McClellan oscillator. That would help support the new highs and new lows also getting above zero. But it's a small number. It's not back above 100 yet, and it's definitely not back above its moving average yet. So that's something to pay attention to there. What has also gone below its moving average is the skew, and when the skew is below its moving average, that's kind of the sign that we are bearish now, and so that's something to watch for too. It's been such a good rally, skew above its moving average as we moved up higher here, and now we appear to have peaked and moved lower. In fact, when you look at, you know, the number of stocks relative, you know, that are above or below their 250-day moving average as a ratio to each other. We have spiked up to above 1, to a strong number here, well above the moving average. And all these other spikes above the moving average like this have been associated with these peaks. And we'll see if we end up rolling back down as well on this chart. So So there are signs that we are, a lot of technical signs that we are just starting an intermediate decline. And today's little move higher as a result of the drop in the dollar and the drop in yields hasn't changed that fact. You still have the 10-year, 2-year yield spread near its lowest levels of this last 6 months, pretty much of this whole cycle. And it hasn't changed. And remember, when this goes higher, that's bearish, right? That puts pressure. I mean, being down, going down is not bad. Being so negative in and of itself is not bad, as we've seen. As it's dropped, the markets have been relatively bullish. But when it starts to move back up, as you've seen the 10 and 3 years started to move back up, then that puts pressure on equity, on risk appetite. Because something's got to give in this ratio. Either the Fed's cutting rates, which is not good, or the long-term yields are rising again, which obviously which would be a sign of higher inflation expectations, and not necessarily good either. As I show you, generally, these inflation numbers are still expected to be higher here going into the next month, in this case the February cycle. That's still a pretty strong number when you look at let me close some of these down here. When you look at the CPI, the month over month here, 0.55%. So this is 0.51. So 0.55 again would be a strong number. Just to kind of give you an idea, like over 10 years, this would have been the strongest number of the past 10 years, except for that one right there. 0.55 would actually be higher than that. So inflation is still an issue, right? It's still an issue, and we are not, here to a positive yield spread yet. We are still, kind of in these negative levels, -2%. So we still are trying to get the Fed funds rate positive, and with the, this getting some higher numbers over this last month in January and expected to get another one in February. All that's doing is slowing down this year-over-year rate, right? You can see we had been dropping pretty sharply from a year ago. We've been dropping pretty sharply, and here, let's do this percent change from a year ago. A little below 6.5%, but then we stalled at 6.34%, and as I said before, we're expected to be at 6.23. So so we're really slowing down that pace, and I think I've shared with you before too the PCE here. When you look at the PCE, see, do I have it up? I think I don't have up the. Let's go to. Oh, sorry. I wanted to look at the trend mean PCE. And again, so here's January's number, and it barely dropped, right? So, here we are, 5 months away from the peak in August at 4.75%, and we're still at 4.63, whereas 5 months we were here, 5 months going into that peak. So we're still very sticky, and that's why the Fed is still willing to raise rates and keep rates higher, and you see that reflected in the interest rate hike expectations, which dipped a little bit yesterday. Another reason why we had a little bit of lift in risk appetite, but there's still a 1 in 4 chance that we get a 50 basis point hike, but more than likely a 25 basis point, but 100% chance of a rate hike, 100% chance of another rate hike in May, so 100% chance with a 29% chance that one of these two will be a 50 basis point hike, and then of course you can see now by June you're looking at about a 75% chance of being at 550. So 25 or 50 25. I mean, there's a high likelihood that's priced in, and then of course by the end of December you're looking at a 92% chance that we'll be at 525 or higher by the end of the year. So if we have a 100% chance of getting to 525 and a 90 some odd chance of still being there by the end of the year, and that's putting pressure on risk appetite. It's going to limit upside because of the higher cost of capital compared to what we've seen over the last couple of years. Let's take a quick look at how the sectors did here today. So let's move over here to the sector comparison chart and just look at today here. All right, and you can see the consumer discretionary having a big move higher. To technology also, so your QQQs, but pretty much it was mostly consumer discretionary, as you see when you look at, I don't know why that's on that side of the chart over here. When you look at the market outlook, market watch, excuse me, this visualize tab, you can see Tesla was a big move higher. Amazon was up a little bit. Some of these Chinese companies doing pretty well, but mainly it was Tesla from a consumer discretionary standpoint. There wasn't a whole lot of positive moves elsewhere in the area. You can see chip stocks still not necessarily doing too well, though Nvidia had a pretty strong return, and Microsoft and Apple, Google were all positive as well. But some of these healthcare stocks not doing well, financial stocks. So if you take a look at, you'll see that Schwab here in just a second. They were all lagging behind the S&P 500 along with utilities or safe havens. So it was a risk-on day from that perspective. When you take a look at, considering that they've been the biggest losers here for most of this move to the downside here. Let me see, when did we start this move to the downside? So so starting on February the 3rd is when, so we had the exhaustion gap move higher on the 2nd, so pretty much since February the 3rd. So let's go over here, starting on this day. So again, they've been the biggest losers, and this communication service is still lagging, down 10% since that day. But you can see how discretionary had been lagging, and it still is. Technology is kind of matching the market, and your safety trades are kind of your better performers. Utilities kind of struggling here, but staples holding up well. Energy had been doing well, still holding up okay. Industrials and financials holding up okay despite this weakness. And then there's healthcare. So a little bit of an oversold bounce for some of these areas, and that's all today was. So it was a risk-on day, but it wasn't necessarily oh man, we should really bounce back up. We're not above these highs yet on any of these sectors, and you can see, we have dark pink shading and red lines across the board here in a lot of areas now, and we're getting to that area in industrials, and these two are kind of working in that direction too, unless we get a significant bounce here along with communication services. So not necessarily the kind of pattern you like to see when you're bullish. These are not the colors you want to see. Here's the main of the same charts for all the main countries out there, China included, and you can see China and Korea kind of a proxy for global economic growth expectations, and got a cluster, but dark pink shading and a red line all across the board on a lot of these areas. Just a few that aren't quite there yet, but at least light pink shading on those. So you see what's going on, and we are, in my opinion, on an intermediate decline. It's just a matter of at what stage are we on. Some are further along in that decline than others, and it looks like the U.S. is just kind of starting that pattern there. All right, that brings us to our trade idea of the day. So let's take a look at Charles Schwab. That's the trade that we decided to do here in our Market Outlook video, Market Outlook live video that we do at 3:30 Eastern time. You can see the engulfing pattern it had, a big move to the downside after a spike up on the momentum line on Friday, big drop back down to extreme lows on the momentum line, kept the near-term line, intermediate line below its market sentiment. They're both falling. Markets intermediate line turned back down, so one day of green shading. And it crossed above and back below the 50 level, so we went from dark green to dark pink, just like that. And we also still have a moving average that's falling. So it looked like we had a kind of maybe a little one-day reprieve before the big engulfing pattern kind of reversed that sentiment to the downside. You can take a look at the long-term view for Schwab. And you can see we have the falling PPO, we have a red arrow on the 10-week moving average. We tried to get bullish, we've reversed that. We're trying to see if we got the transition candle from what was temporarily bullish, and we're looking to reverse that pattern there. You look at the MACD and the stochastic indicators, and you can see, we crossed below all the moving averages. In fact, all the moving averages have crossed inside the range of the last 3 days, and we opened way up above all these highs today, and then bam, closed below all those lows. So big engulfing. MACD is negative, below its moving average. Stochastics is dropping into below the midpoint of its chart now, or negative now in the MACD. So things are turning south for the stock. We are down into the lowest quartile of the range. We haven't been, this is the first day we've been in the lowest quartile of the range. The bands are inside the Keltner channels. We've had positive momentum. We never did have enough to expand out, and now we're reversing. So it looks like, we are kind of starting to work our way down to the downside here. Here's the Ichimoku cloud. You can see we are below the cloud. As it turns pink, we are below the cloud. We have whatever bullish trend we have. We don't have a strong trend going at all, but we are working in that direction. The rate of change is close to turning negative. Has been negative for a while. It went temporarily positive here today, but you expect that will just be a one-day phenomenon, or maybe 2 or 3 day phenomenon, and we'll get back below these candles and be negative again, which would be bearish, obviously, for the stock. So what we decided to do is to come over here and do a long put vertical spread. So we bought the at the money put, we sold one strike away. So this is what it looks like on this chart. Position size for, let me get rid of the working trade. Position size for my normal half my normal position size from a risk standpoint, and then going for almost double that. So relatively higher probability trade, but again, considering that we typically put for our typical high probability strategy, we typically put $1,000 of risk for roughly $300 of reward. So we're going for about half of that and getting almost 3 times our typical reward. So it's a good reward for the amount of risk for what we normally do on the short vertical iron condor side of things. But it is, you can see the flexibility we have. This is a 1 standard deviation window, and that's how much room we have for it to go down, or at least go up, but still have a possibility of it still working in our favor. And as as it goes up, as long as it doesn't change, if it doesn't break out to the upside, in which case, no matter what it looks like over here, we close out the trade and take whatever loss we have. But knowing that we're more than willing to take that full loss because we're trying to get a reward that's almost double that. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join our website at marketscholars.com for free. Follow us and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.